right, T, ready? All right, T, I'm all, thank you. Okay. Go ahead. Okay, we're all set. Sorry about that. Okay, Mayor, we're all set. Sorry about that.
Okay, no, not a problem.
Sorry
I
about that.
appreciate everything you guys do.
Okay,
All
all
right,
set.
it is 4:07. We'll call the meeting to order and we'll do a roll call vote. To Sherry.
Mayor Alorza,
Present.
Vice Chairman Lombardi,
Present.
Councilman Igliozzi is absent. Ms. Silveria,
Present.
Mr. Costello,
Present.
Mr. Hirsch,
Present.
Mr. Winkleman.
Here. Winkle.
We have 6 present and 1 absent. We have a quorum.
That's great. Well, thank you everybody for making time. I really appreciate your continued commitment to this work, especially on a Friday late afternoon. So let's just jump right in. We'll go to investment performance analysis. Hand it over to Eric. Take it away.
Thanks, Mayor. Hello, everyone.
Hello.
As usual, if you were to turn to page 1 of your document, the first page, I think on the electronic box, it's 4 out of 64, but it's written as page 1 at the bottom. It's our estimated investment position and performance analysis through the 16th. And you can see that the markets have rallied. You see some strong returns for equities across the board since the beginning of the month, and really since our last meeting. You see that the portfolio is up 2.9% over that time. You see that value has actually done reasonably well over that time. It's had a little bit of a rebound relative to growth, still trailing by a wide margin. And in general, markets have been rallying in recent weeks on hopes of stimulus and related, of course, to the outcome of the election. So in recent weeks, Vice President Biden's lead has widened to a substantial lead, and markets are therefore pricing in, for the most part, that the probability of a stimulus soon is high, and the probability of that stimulus being very large or larger in the case of President Trump being reelected has been generally driving markets. So if you watch closely, you'll see as the negotiations between Secretary Mnuchin and Speaker Pelosi go back and forth, the market is sort of watching very, very closely. In fact, the last few days, not today, but the last few days, had a bit of a sell-off as the numbers tightened a little bit in the race and in the battleground states. Still a solid lead for the vice president, but as those numbers tightened, markets really didn't like that, because the one thing they want the most is the stimulus, and they certainly don't want a drawn-out, disputed election, contested election. And the wider those numbers are, the bigger the lead is, the less likely that occurs. So that's what's been driving markets recently. By way of context, just to see how large these numbers are that we're talking about, President Trump has already come up to about $1.9 trillion in his offer. The House Democrats, led by Speaker Pelosi, are around $2.2 trillion. The Senate Republicans are far less than that, less than $1 trillion. But that has been driving the debate. And for example, in the second quarter, U.S. GDP, just to give you an idea of how big these numbers are, contracted at about a 33% annual rate, 32.9 actually. So call it a third. Now that's annualized. So if you were to sort of say what happened in that quarter, it was close to an 8% decline in the quarter of U.S. GDP. Well, when you're over 20 trillion a year in nominal GDP, that's a big number. So that's well over, that's 1.6 trillion or so that we lost that quarter. Why does that matter? Well, to give you an idea, that with this, the previous stimulus that passed, the CARES Act, was almost 3 trillion. And this stimulus that we're talking about here, as previously mentioned, could be 1.8, 2.2, 2 trillion or even larger. And 2 trillion is 10% of GDP. So the size of the stimulus is just gigantic. Now, no matter who wins, there's going to be additional relief and stimulus, and it's going to be large in any case. It's just how large and when is really the question, and that's what markets are dealing with right now. So that's going to make a difference. When you add to that the massive and continuing intervention by the Fed, and the fact that in coming months, markets are predicting good news on the vaccine for the virus, and going forward, unfortunately, things are going to get worse before they get better in the coming 1, 2, 3 months, etc. And that's not good, but markets tend to look past that. They look into the middle of next year and 6 months after that and a year after that, and they're pricing in these points we've been discussing. So enormous stimulus, fiscal coming, already in place, very long-lasting and enormous monetary stimulus, good news on vaccines, and you could have some real strong economic growth next year. Unfortunately, those things get worse before they get better. And that's really been driving the bus, so to speak. It's affecting interest rates. It's affecting equity prices. It's affecting the dollar. And as that goes, so will go, I think, the markets here in the short run. So we should continue to expect continued volatility, noticeable volatility in both directions, although we still remain positive for, say, next year as a whole, even though we have these next few months, et cetera, to get through, and that will continue to cause volatility. And the election is still going to continue to cause volatility. If you look in the volatility markets, they're predicting volatility, continued volatility, especially around the election and shortly thereafter. So be prepared for that, depending on what happens on the night of the election and whether or not anyone concedes or tries to contest the election. That could have an impact for sure. But luckily, so far this month, it's been a strong month, going in the right direction. And because of this stimulus talk that we've been discussing, you're seeing value stocks do just as well or even better than growth in recent times, and that's a big difference from previous months and quarters. And just to drive the point home, I always like to update you as of the data that you have here. For example, year to date, just to show the dichotomy, Russell 1000 growth is up 29.5%. That's the index itself. Russell value is down 8%. So that's a huge spread, pushing 40 percentage points. Russell mid growth up 22%. Mid value down 7.7. Small growth up 12.5 year to date. Small value down almost 15% year to date. So that helps explain what you see in terms of your numbers on a year to date basis between the various value and growth strategies. Rates have really remained quite calm. You can see that both of our bond exposures are doing very well year to date. Up, Loomis is up a little bit month to date. The Treasury exposure we have, the intermediate term trade is down just a little bit year to date, but still both of them very strong year to date, 7.3 and 7.9%, respectively. So rates have been ticking up a little bit on the Treasury curve. That's on the stimulus and perhaps the arresting of the deflationary impulse from the pandemic. Markets are starting to price that in. We don't think the Fed is going to stand by and allow rates to go up a lot or noticeably. They will probably increase their quantitative easing program to keep rates, especially in treasuries, from going up too fast, even though they don't mind seeing them go up a little bit, because that signals that markets think the economy is healing. So that's really what's been happening since our last call. And unfortunately, I think we have to be prepared for some more, at least for a while. But the sort of the intermediate and longer term is looking better, sort of by the month. And with the tailwinds of fiscal and monetary stimulus behind it, we sort of expect to see more of the same. So I'd be glad to clarify or take questions on that area or on any of these areas if there are any.
Eric, can you walk us through, and during our last meeting, we had a conversation about the returns in our, I guess, I forget what specific part of our portfolio, but comparing it to the benchmarks. So can you walk us through that?
Sure, Mayor. If you were to turn through if everyone would turn through their same book that we're referencing, and if you went to page 9 in the package, electronically, it's page 12 out of 64. It's called the 12-month return contribution analysis. This was a request from the last meeting, and it's complex and it's a little hard to follow, but unfortunately, there's no way around it. So what we've done is we've shown you what the manager's returns were over that 12-month period that you requested. And we've shown you what the returns of their policy benchmarks are, and of course the weights in the policy benchmark and the weights of the managers themselves across that time period. So that's one of the areas of complexity, because the weights change over the year noticeably, month to month. We do our rebalancings. Remember, elsewhere in the book you could see that there's a lot of money that comes in and out of the portfolio. So that has effects on the average weight of any one of the managers across the year. So far this year, through September at least, through October now, you see that 37 million has come in, 72 million has come out. So that's large inflows and outflows can affect these measurements. Remember, the benchmark doesn't consider that. The benchmark weighting that State Street does for us and the calculation, that's constant throughout the year. But of course, the average values of the managers are moving up and down, especially the bond manager, as we put money in and take it out. Last night, for example, another $7 million came out of the portfolio for this month's benefit payments, etc. So we took average weights for the managers across the time period and show their returns, and therefore what their return contribution was for the return of the portfolio. And then next to it, we show you what happened for the policy and their benchmarks and what happened. So for example, just look at the first one, Columbia Value Path, large cap value manager. As you can see, its return for that 12-month period was 1.6%. The return on the policy benchmark was 84 basis points over that time. So it outperformed the benchmark. However, its average weight was a little higher than the benchmark. Remember, we changed the managers, we changed this benchmark We removed money from Columbia. We pulled other managers out during the year. We made a slight change in a meeting a few months ago for just a temporary deviation from the benchmarks. In any event, that's what the averages worked out to, and you can see, therefore, that in the column called return contribution under the fund category, Columbia Value Path contributed 9 basis points, 0.09%, or 9 basis points to the return of the whole fund over that 12-month period. The benchmark, at its weight, contributed 4 basis points. So in that sense, Columbia Value Path outperformed by 5 basis points. That's the yellow column. So the total effect to the difference between the return of the fund and the return of its benchmark was a positive 5 basis points. So over that 12-month period, Columbia contributed 9 basis points. The benchmark only 4, so it actually outperformed. Now, in the 2 columns next to it, we break out the effect of the manager's performance and the weight, the effect due to its average weight, perhaps being different than the policy weight, which is somewhat unavoidable across time. We rebalance all the time, but lots of inflows in, lots of outflows. So we broke it up in the column. And you see they add to the 5 basis points. 1 was because of its weight, 4 because of the manager. And you can walk down and look at these individual managers. Now, look at SSGA, Russell 1000 Growth. That's an index fund, standard Russell 1000 Growth index fund. You'll see that it returned, the fund, 44.3% over that 12-month period. Now, its benchmark did the same thing. It's the Russell 1000 Growth. So that passive index fund is benchmarked by SSGA to the Russell 1000 Growth, and it matched. Oh, sorry. Go ahead.
Yeah, if I can just jump in, I get it, and we're following you. So,
okay.
Correct me if I'm wrong. So the average weighting, which is what starts to make this complicated, the value of that, the value of including the average weighting, is only to the extent that that helps us calculate the total effect that each investment has on the portfolio. And we add that up.
Correct.
The total, right? So what we're trying to accomplish through this exercise is look at each investment and see how it performs to the vis-a-vis its benchmark. And if that's the case, then I think the best analysis for us to go through is simply to compare the 12-month return under the fund column or fund section to the 12-month return under the policy section, and see which one.
Yeah.
And see which
yes.
we're performing, we're not as performing as well on. And as I go through these, 3 of them stand out. Brandy's. So our 12-month return was negative 3.6. The policy was positive 6.13.
Correct.
Vanguard, Total International Bond Fund. Our returns were 0.9%. The benchmark was 4.3%. And then Renaissance was negative 8% for us and positive 5% for the benchmark. So, I'm sorry to jump in, but I think that the conversation with this commission, I think it'd be most helpful if we focus in on those investments specifically, and then also if anyone else wants to highlight any others that you're concerned about, please feel free. But going through this analysis, those are the 3 that really stand out to me that we need to look into further.
Okay, sure. On the Vanguard Total International Bond Funds, the difference is just its index. That fund, that passive fund, benchmarks against an index which is slightly different against the policy benchmark, because the Vanguard Total International Bond Index is hedged. It's currency hedged, and the benchmark index is not. So, for example, if you were to turn to page, and then I'll move on quickly. I'll get to the others that you want to talk about. But if you were to turn to page, here it is, page 54 in the book, you will see what you brought up, Mayor, but it will also show what the answer is and what the nuance is and why you want to understand that it's just the passive benchmark that's making the difference, just the two benchmark differences. So, for example, again, this is on page 54 in the book, or 57 out of 64 in the PowerPoint. You'll see over the trailing 1 year, it's done 2.2% versus 5.6%. That's the same data. But since inception, when we got in it, January of 18, it's compounding at 5.2%, and its benchmark is only 3.3%. That effect, the outperformance since we got in 2 years ago, not quite, or the underperformance for this past year, is almost solely due to currency between the dollar strengthening and the dollar weakening. So when the dollar weakens, the benchmark, the policy benchmark will do better. When the dollar strengthens, the opposite will occur. So the dollar strengthened a lot in 18, and since the beginning of 18, 2 or 3 years ago since we started, 18, 19 into this year, and vice versa. So since we got in, it's beating its benchmark by a wide margin. This year it is trailing by a wide margin, and it's currency effects. There's no active management in this. It's an index fund. So that answers that question.
Okay. So Eric, is this the right index then?
Well, that's a fair question. It would be perfectly okay to change the index to the currency hedged index. That's a decision for the board. It would be perfectly okay. What it would do is it would keep the returns of the portfolio, that and some other indexes, for example, that you could change, would keep the return much more closely pegged to the benchmark, because remember, many of these managers are passive. A large portion of our exposure is passive, and that would keep the differences from being wider or smaller across time, and keep it much closer to the benchmark.
You said something just now, Eric, that I found interesting, and I don't fully understand. You said that it would be the commission's decision on whether or not to change the benchmark. Can you tell me more about that? I thought that the benchmark was just something you selected, under the guidance of the board or the commission, but just to represent whether the investment is doing well or not. So can you tell me more about that? Do we select what the benchmark is, or is there a substantive impact to what the benchmark is, or is it just for representation so we can compare our investment to something else?
Yeah, I think it's really both of those things. So with our recommendation, of course, everything is up to the board to accept or reject. The board could choose to do so. Remember, this policy benchmark is old. It's been around for a long time. Previous board constituents had wanted those indices as they were for their various purposes. But again, it would be fine with us to peg those benchmarks more closely to their own indices, and then your differences would go away, at least in some of these cases, with passive funds versus their benchmarks. So either is fine. They tell you a slightly different story, but either is fine. I always think about it both ways when I'm analyzing things, but either way would be perfectly acceptable. And we could come back to you next meeting with our recommended changes if the board was interested to have the passive benchmarks be compared in the policy benchmark to their own exactly identical index with no differences.
This is David. I have a comment regarding that, though. We've chosen to have that policy of international investing done hedged as opposed to unhedged because it's the judgment of either the board and or the advisor that doing it unhedged over the long term is better. So I see no reason to change the rules to make it look better. That's how we implemented our foreign bond allocation. If we want to implement it to a non-hedged, that's fine. But I think if our policy is A, then we shouldn't try to work around ways to make the actual look better to conform to the policy. And that gets to a deeper question later on. I know Eric now, for a lot of these funds, shows their performance relative to their benchmark, and also the policy. So we're implementing, for example, our equity in general. We have a value tilt. Well, over the last several years, that value tilt has cost us performance, as opposed to either the blend or being in a growth. But we don't change those indexes to show that we're not doing as badly as we think. So the second piece should be, I think, before we pick an asset to implement a benchmark, we should really look at what are those indices and how do we pick those indices? And once we pick one, we stay with it because that's what our policy says. And in addition,
I agree with David.
and you're looking at a 1-year period. In Eric's earlier talk, he said, markets aren't going to react to this till next year, maybe even the year after, later next year. A year is nothing to a long-term investment like this pension. And we should keep our eyes on the horizon, not on the little waves that we're trying to avoid on the way out.
So, David, can you?
I agree.
David, can you just help explain that to me at least? So, the purpose of these presentations are to help us evaluate how our investments are performing, right? And so you compare an apple to an apple. But from Eric's presentation, it appeared to me that we were comparing an apple to an orange. And so my question was, should we change the benchmark so that we can have a better comparison to evaluate whether our investment is performing well or not?
We do that. If you look at the detail for each investment manager, whether it be an index or not, take Vanguard's a good example in the equity. We now report to the CRISP benchmark, which is what Vanguard does, but we also do our performance benchmarking to the policy, which may be the Russell benchmark. So policy states Russell, but we've chosen to implement it with Vanguard using CRISP as their benchmark because we think we'll get better performance. The CRISP is a higher hurdle than the Russell, and time will tell. I mean, if you take that to an extreme, Mayor, why don't we just buy the Russell 3000 for our domestic equity and not make judgments about whether mid or small or value or growth is going to win out?
So this is more my question. So Eric's explanation for the difference between the Vanguard and the benchmark is that there's fluctuation in cash. Cash is going up versus cash is going down. So my question is, shouldn't the bank,
His explanation is that Vanguard fund is currency hedged and the benchmark is not hedged.
Mhm.
right? And so my question is, shouldn't the benchmark be one that is also not hedged? Or let me make sure I get it right. So Vanguard is hedged or not hedged?
Vanguard is hedged, the policy benchmark is not.
Right. So my question is, shouldn't the policy benchmark also be hedged?
Yeah, I mean, I think Mayor, you make a good point, but I think what David was just saying was that, we don't want to be fooling around with the indexes to make our numbers look right. That's not what we're
No.
after.
No, that's not what I'm suggesting. It's not to make it look better. It's to be able to compare.
Yeah, I think that's fair. A little bit of a side. One of the things I've seen on several other committees I'm on is as a way of just saying, look, if we were completely passive, what is a 60-40 S&P, and bond index? What does that look like?
Yep.
And that, by including that as a bottom line index, one of a few, because a bottom line benchmark, one of a few, you can then evaluate not only how our individual managers are doing, but also, candidly how Wainwright's doing, because we're not picking these funds. And it's a way of just saying, okay, in a generic universe, assuming we knew nothing about anything and we just took the most traditional approach possible of a 60-40 split, what do things look like?
So
And,
Mike, you mentioned something that was at the top of my list here when we got to it, which is in that page 1, there's always a box showing the S&P 500 to the whole total portfolio. And I don't understand the purpose of that. What should be in that box, in my opinion, is the MSCI All World Equity and the equivalent to MSCI All World bonds. And that's if you're going to be agnostic to how you implement that. Now, how we implement it is the detail of the portfolio, and our returns tell us, was our judgment better, and therefore we outperformed the whole passive world indices, or worse?
yeah, I mean, clearly the problem is we've been way overweighted value in an era that has been, relatively unprecedented. The gap is this wide and for this long. And, that's cost us probably, could be as much as 2 or 3, 4% a year over this stretch. Does that sound like a reasonable number?
Yeah, I'd have to think about it depending on what you mean by this stretch, but you are correct. The gap has been enormous, unprecedented, and I've never seen anything as wide in my career or in the historical data where you have a 40-point spread between large growth and large value over a 1-year period, for example.
And the same can be said for size, large versus small.
That is also correct. It's even more extreme in terms of size as well. Small cap and mid cap. Really, the only thing that's done great, well, growth has outperformed value and large cap has outperformed mid and small and international and real estate and hedge funds and everything else. It's being driven by that. You are correct.
Yeah, I think we should decide what the bench should be. There should be an overall bond, overall stock, maybe some cash, and you figure out what percentages are in each, and that is your goal, not the goal, but it's the benchmark, and you compare to that. That's what I've always seen done. That's what I look at in my portfolios.
Right. So the policy benchmark has mid cap in it. It has small cap in it. It has international in it. It has bonds in it, because those are the weights of the exposure. So there's many different questions a board could be interested in, and there's many different ways to get those answers. In the case of Vanguard Total International Bond, there wasn't really much passive, hedged international exposure to get that would be large. The Vanguard fund is $156 billion, and it's very cheap, but it is currency hedged. The index, finding passive exposure against that index was difficult to find somebody large enough. So based on cost and a desire to have passive exposure, remember we used to have active exposure in that slot, that's why the Vanguard Total International Bond Fund was chosen. And that's where you get your currency difference. And that will always be the case. You can see since we got in it, beating it by a wide margin. That's because of the dollar strengthening on average over that time. But when the dollar weakens, the reverse will happen, such as year to date.
Well,
So
exactly.
in order to have passive exposure, that was really the best choice that we had.
Yeah, remember what you said earlier, when we got into it, the hedged outperformed the unhedged. And guess what? We'll have this conversation the other way at some point in the future, because
That's correct.
that's what happens. So you pick your horse and you ride it for the long term.
Yes, that's correct. I mean, the fund itself is doing what we hired it to do. It's doing exactly what it said against its hedged benchmark, which we could try to add to the book for further, on its page for further clarity. But it's doing what it's supposed to do, tracking it closely. It's doing exactly what it said it would do when we and other investors purchase it.
Okay.
So moving to your other the other two that you were referencing there, of course, the big difference is being driven by Renaissance this year. That's cost you 170 basis points. That's what the yellow column shows relative to the policy benchmark. That's because it's underperformed this year. Now, in the long run, it has beat the benchmark by a wide margin. It's one of the very best managers out there, but it has underperformed this year especially, and that's what's driving it over that 1 year period. Again, it's only a 1 year period, as Mr. Hirsch points out. If you looked at it a year or two ago, you would have a very different conclusion, and if you look at it a year or two from now, you might have a very different conclusion. It's got a very low beta running around 0.4. It's got a low correlation. Much lower standard deviation than the market, and it beats it on a pretty regular basis over time, and it's been one of our strongest performers. However, over that 1 year period that you requested, it's the single biggest detractor to performance relative to the benchmark. And this has happened many times, or several times, I should say, in its history with us, going back to 2006. There have been many periods like this, but then sometimes it'll absolutely clobber the markets and or the benchmarks. And I could show you I could give you some data right now if you want. I have it in front of me, but clearly over the last 12 months, it's been the single biggest detractor relative to the policy benchmark. Brandis has been the second biggest, and you can see that's cost 115 basis points. If you turn to if you were to look, you don't have to, but it tracks the EFA value. Remember, it's a deep value manager. This gets to the point that Mr. Hirsch is making. It's tracking value. That's what it does in the international marketplace. We judge it against EFA, which has both growth and value in it. So when value, and it's been even more stark in the international marketplace, the value growth differential. Over the long run, many practitioners and theorists, academics believe value what does beat growth, and certainly our experience has shown that it's beaten the index by a very wide margin, EFA that is, over that time period. However, value has so underperformed growth, and you can see it in the indexes. It tracks its EFA value index pretty well across time. It oscillates a little bit, but it beats it in the long run. But recently, in recent years, not just this last year, it's just been the growth value story. So they doing what they told us they were going to do. They're sticking with their deep value approach. It's just been a very out of favor sector in the marketplace. I happen to think it's due to central bank policy, interest rate policy, which is why I've said in some previous meetings that I think growth on average would continue to outperform value for the time being. But nonetheless, that has been the second biggest detractor over that 1 year period that you asked us to show you about.
So this tracks very well. If you turn to page 48, which is Brandis on the longer term, and I think Mr. Mayor, you'll see what we're talking about on the International Bond Fund. The EFA is the policy, the red bars, and that's a blend of both growth and value. And you can see Brandis in the green has underperformed that because we decided to have our international investment favored toward the value style, not blend and not growth, because we believed, and I still believe, that over the long term, value will win out. So the real comparison for Brandis is the yellow and the red. What we hired them to do is be a value international manager. And they've clearly, in most cases, as Eric points out, beat that. In fact, in the 3 years, they beat it quite handily by over 6.5%.
Where do you see the 6.5%?
The value underperformed by 5.9%, and Brandis did 0.6%. So there was a swing.
I think, well, as I was reading that, the EFA was 0.6%.
Yeah, Brandis is.
Sorry, EFA. Sorry. Thank you.
Brandis was down
But they still,
4.7.
by 220 basis points beat the index for their style.
Which, when you look at year to date and trailing 1 year, it's hard to understand where that came from. I guess it must have been 2 or 3 years ago. 3 years ago.
Correct. It does track value much closer. You're correct. EFA, because it has a lot of growth in it, can be quite different across time. And in an environment where the difference between value and growth has been so extreme, that's why you see the numbers the way they are. This has become a huge topic across the entire industry. Is value broken? Is it dead? Is it never coming back? I remember sometime, in the early 2000s, people were saying that about growth. Is growth dead? Is it ever coming back after the tech wreck and the NASDAQ collapse and the tech bubble blowing up after the 1999 run-up? And it just goes back and forth across time, although without a doubt, this is the most extreme differential, I think, ever in the data, ever, over generations.
It shows that Brandis is doing what we hired him to do.
I think that's correct.
Okay. Well, going back to the comparison that Eric put together for us, any other questions on that page 9 of the packet?
Okay. All right, thank you.
All right. Well, if there are none, then I'll entertain a motion to accept the investment performance analysis as just presented by Wainwright. Is there a motion on the table?
But I have a question.
Sure, of course.
On the previous page, I think it's 8, because I have to go back and forth. On contributions, I noticed we're way down on contributions for the year to the fund. I have to go back now to the,
Yeah, last year over the 10 months, we contributed 71 million to the fund. This year over the 10
Yeah.
months, only 37. And if we
yeah,
do the whole year, we're going to need another 40. If we equal last year, we'll need another $48 million contribution before the end of December.
mm-hmm.
Larry, can you speak to that?
That's my,
I can, Mayor, if you if you would be so kind to allow me to speak. Myself and Ms. Silveria are keenly aware, as is the treasurer, that while we still are waiting for an appropriation of the state government and certainly our city appropriation, normally, commissioners, we extinguish the remaining outstanding balance of the prior year pension obligation, generally in the first 2 weeks of July, on the strength of the receipt of the so-called pilot funds. While those pilot funds were held up at first and are now being paid to the city in 1/12 appropriations under state statute, and we are taking those 1/12 payments and immediately applying to the outstanding balance, that balance is now down to about 23 million and change. We would have ordinarily had that paid off in July, and you would have saw that influx of cash. And likewise, had we not had COVID conditions prevailing, bearing in mind that we're working steadily off of mostly tax collections and some reduced department revenues, we would have prepaid a lot larger sums than we did already. We put in $10 million this year thus far in the fiscal year 21 pension obligation. So I would say, Mayor and members of the board, that by about now, by tradition, we're lagging behind in cash flow for those reasons. 24 million that's yet to be paid for the prior year, and at least 10 million more. I would say about 35 million initially, at least, and then we would have been paying as cash allowed as much as we could as early in the year to save interest on the pension calculation. But Mayor, to that point, it clearly has got to do with the reduced activity associated with the budget not being appropriate yet by the state and therefore the city as well.
Yeah, and I do want to add that it is fully our intention to fully fund or fully make our art payments. So
absolutely.
Any other questions on any part of the report? All right, so if there are none, I'll entertain a motion to accept the investment performance analysis as delivered by Wainwright. Is there a motion?
I so move.
Commissioner Winkleman moves. Is there a second?
Second.
Seconded. Who was that? I'm sorry.
Mr. Costello.
Say it again.
It was Mr. Costello.
Mike Costello.
Yes.
All right, seconded by Commissioner Costello. Any discussion on the motion? All those in favor, please say aye.
Aye.
Any opposed? All right, the ayes have it. The investment performance analysis is approved. Move on to matter number 2, discussion and/or decision relative to Israeli bonds. I'll hand it back to you, Eric.
Oh, thank you, Mayor. If you turn to page 10, the next page of your package, you will see what State of Israel bonds choices are right now. As many of you know, the city has held State of Israel bonds more or less continuously, quite regularly over, they were doing it before we were brought on, and they've been doing it the last 20 or 25 years. The bonds have redeemed to about 2.3 million. We have discussed with Loomis Sales, our bond manager, what they think the best choice is of the bonds available. You have a 2 or a 3 or a 5-year bond to choose from. Loomis prefers the 2-year bond. They like that duration and yield combination the best. It makes sense to us. Short term matches, or it's in the duration range of the bond manager. So we're recommending, as Loomis has recommended, to go with the 2-year bond. As you can see, it's a 1.16% interest rate. The bonds are, remember, these are government sovereign bonds, AA- rated, very high up the investment grade scale, like most of the other exposure in the bond portfolio at Loomis. So we recommend the board consider reinvesting the redeemed proceeds, as Loomis Sales recommends, into the 2-year Jubilee fixed rate bond that you see in your package on page 11, the next page.
Okay. Any questions for Eric? Commissioner Lombardi?
Are there any transaction fees?
I don't think so, sir. I could check, but I really don't think so. I'll have to check. If they are, they're extremely small.
Okay.
These are directly.
And is it
These are directly purchased from the State of Israel organization. So there's no sort of.
And these are.
Go ahead. Sorry.
Are they U.S. dollar bonds?
Yes, they are U.S. dollar denominated.
Any other questions or comments? Commissioner Lombardi, do you want to move that pages 10 and 11 be entered as Exhibit A?
I will make that motion, Mayor. Thank you.
All right, motion is made. Is there a second to
So move.
enter pages 10 and 11 as Exhibit A? And that's seconded by Commissioner Winkleman. Any discussion on that motion? All those in favor, please say aye.
Aye.
Any opposed?
Aye.
Okay, so pages 10 and 11 are now Exhibit A. I'll entertain a motion to accept Wainwright's recommendation as articulated in Exhibit A. Is there a motion on the table?
I'll make that
So
motion.
moved. Okay.
So moved by Commissioner Lombardi, seconded by Commissioner Winkleman. Any discussion on that motion? All those in favor, please say aye.
Aye.
Are there any opposed? Okay, the motion carries. All right, we will move on to matter number 3, discussion relative to the Dexter Donation Fund and other trust accounts. Hand it back to you, Eric.
Thank you, Mayor. I can go quickly. If you turn to your other package, as we do normally, you can turn to page 1. It's Dexter Donation that we start with. You can see it's up 3.8% month to date, year to date over 3%. Again, more equity, no hedge funds, no private equity, no alternatives, that type of thing. So as you can see, same value growth differential for the funds. So the story is the same there. We don't have any changes for you at this time. Recommendations, excuse me.
Okay, any questions or comments for Eric? I'll entertain a motion to accept the investment performance analysis for the Providence Dexter Donation Fund and other trust accounts. Is there a motion on the table?
So moved.
I'm sorry, I missed that. Who was that?
David.
All right, so moved by Commissioner Hirsch. Is there a second?
So move.
Moved by seconded by Commissioner Winkleman. Any discussion on that motion? Okay. All those in favor, please say aye.
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 Opposed? Okay, the motion carries. All Matter is approved. And last, we move on to matter number 4, discussion relative to claims and litigation. I don't believe there are any matters to discuss there. So I will entertain a motion to continue agenda item 4 until our next Board of Investment Commissioners meeting. Is there a motion to continue?
So move.
Moved by Commissioner Winkleman. Is there a second?
Seconded.
Seconded by Commissioner Costello. Any discussion on the motion? All those in favor, please say aye.
Aye.
Any opposed?
Aye.
All right. I'll entertain a motion to adjourn.
Motion to
So moved.
adjourn.
So moved. Is there a second?
I'll second it if I didn't make the motion.
Second.
Seconded by Commissioner Lombardi. All those in favor, please say aye.
Aye.
Aye.